As the nation's largest retailer, when Walmart shares their forecast for the coming year, it's really important we all pay attention to what they have to say. And unfortunately, just recently, Walmart issued a major warning that we all need to know about. So let's jump in. Let's start off with a USA Today article, and their reading of the tea leaves is in the title. Walmart's lower than expected guidance may mean consumer spending is slowing. And that's my read of the tea leaves as well. The article goes on to say Walmart on Thursday forecasts sales and profit for the fiscal year ending in January of 2026 below Wall Street's estimates, suggesting that the world's largest retailer expects inflation wary investors to pull back after several quarters of solid growth. So, not a good thing if the consumer starts pulling back. The consumer is two-thirds of the US economy, and it kind of has this ripple effect, this spiraling impact. As the consumer slows, it impacts many, many other parts of the economy. Let's keep going and learn a little bit more. Walmart's lower than expected guidance is a warning that U.S. consumer spending is slowing, said Brian Mulberry, client portfolio manager at Zacks Investment Management, and also a Walmart investor. At the moment, the labor market is still strong, he said, adding that if Walmart's soft guidance is followed by a decline in jobs, it would be a strong signal that economic growth is slowing. Unfortunately, we've seen that continuing unemployment claims have continued to go up, unfortunately. As I record this, we'll get a new employment report in just a few days. As of recording, I don't have that, but most economists are expecting that trend, unfortunately, to continue. Okay, let's switch articles. An article that Fortune did on it. Walmart stock tumbles on lower 2025 guidance given uncertain times in the economy. We don't want to get out over our skis here, is the quote that they share. And as somebody from a ski town, I use that quote a lot. Not only do companies not want to get out in front of their skis, but as a financial advisor, I would caution all of us to be careful about getting in front of our skis, which means getting ahead of ourselves. And after 2 years of solid growth, after a 2-year period in the stock market, from the October 2022 lows to October of 2024, the S&P 500 was up 60%. That's an enormous move, and it's not unusual for people to have their asset allocation, their long-term asset allocation, a little skewed by that. If you started the year with a portfolio of 70% stocks, 30% bonds, I'm just using an example here. I don't know your situation. This is not financial advice. But if you were 70-30 and the stock market did very, very well over a 2-year period, it would not be unusual for you to be over allocated to stocks versus what you said your long-term allocation was going to be. And it's really the long-term allocation that helps us. So let's go back to the Fortune article where the quote was, "We don't want to get over our skis here." And the Fortune article says the world's largest retailer posted another quarter of growth, but its lukewarm forecast for 2025 sent the stock tumbling. The company cited uncertainty about what would happen with the economy over the next several months as the reason for the slowdown. We we've we had seen clouds on the horizon and they never materialized, Doug McMillon, who's the CEO of Walmart, said. And I kind of feel the same way right now, he went on to say. So they're seeing clouds on the horizon. I think many of us are seeing clouds on the horizon. So the question is, what do we do? And I want to put something out there for you to think about, which is it's important to stick with your long-term asset allocation. What percent of your portfolio is in stocks? What percent of your portfolio is in bonds? Because that's going to determine the vast majority of your success as an investor. It's going to determine the vast majority of your results as an investor. And if you have gotten overexposed to stocks, it's a lot easier to come back to your long-term allocation, to to sell some of your stocks to get back to that long-term allocation. It's a lot easier to do that when the market's at an all-time high, at or close to an all-time high, or within a couple percentages points of that, than it is after the market makes a correction. And unfortunately, the market takes time to go up in value. The saying in my industry is it takes the escalator up, but the market takes the elevator down. So if you wait until, if you're thinking, okay, I want to get as much of this upside off the table as you can. Unfortunately, when the market corrects, it could happen so quickly that you find yourself down 20 or 30%. So rather than try to time the market, really ask yourself, what is your long-term asset allocation? If you don't know what your long-term asset allocation is, I do encourage you to work with a professional to figure that out. I encourage you to work with a financial advisor that's a fiduciary to you 100% of the time, so they're not trying to sell you something, so that your interest and their interest are aligned. The good thing about asset allocation is you don't have to work with an advisor for years and years to get a good feel for your asset allocation. This is something that you can visit with somebody several times, somebody that has experience, somebody that has helped hundreds of people, somebody has seen people go through different chapters of their life. And let me let you inside of the tent. As a financial advisor myself for over 20 years, I've now retired, but when I was working, one of the big things that I noticed is the pain of loss, the angst that the market going down 20, 30, or 40%, the pain that that can cause, unfortunately, once we get into retirement, that can go up not just by 10 or 20%, but it can go up like 10 times. It can feel 10 times as painful. And the reason for that is we don't have new money coming in that we can put to work as the market goes down. We have this fixed nest egg once we retire. And so we no longer can take advantage of lower prices. We're no longer dollar cost averaging in. In fact, if we're taking money out of our account, which most of us are going to have to do in retirement, then we're suffering from the evil cousin, the evil twin of dollar cost averaging, which is what I call sequencer return risk. We are now forced sellers in a down market. And the best way to protect yourself from being a forced seller on a down market is to have access to capital, cash, either in bonds or in your savings, where if the market is down, you don't have to sell stocks in order to provide cash for your living expenses. And the way most people do that, again, going back to the asset allocation, is it's the percent of your portfolio in bonds. And most people would say, okay, my portfolio is 70% stocks, 30% in bonds, 60% stocks, 40% in bonds. Rather than do that, think about how many years worth of living expenses do you have in short-term, high quality bonds that you're comfortable. You're not taking a lot of credit risk. You're not taking a lot of duration risk. You're not using bonds that are going to mature in 20 years. You're using the bonds that are going to mature in 2, 3, 5 years. So if interest rates go up, you won't take as much of a hit, because if interest rates go up and you're in a 20-year bond, well, somebody's got to say, this bond that you own now is paying a lower interest rate over a 20-year period. So there's more of a discount than a bond that maybe is going to mature in 18 months. So that's one of the ways you protect yourself, is by having high quality, short duration bonds in your portfolio that you can access whether the stock market's up or down, and then you don't become a forced seller in a down market. If this video has been helpful, the YouTube algorithm says this next video of mine you'll enjoy as well. So I look forward to hearing whether YouTube was right or not, and thanks for watching this video. Bye-bye.